us well? Yes, okay. So today we'll discuss early stage fundraising in the current climate, considering three factors that influence it. The first is macroeconomics, which we'll focus on. The second is the political situation in Israel. And the third is Gen AI, which you all know, and we won't talk about it a lot because you probably heard enough. Joining us today are Robbie, a partner at Cowboy Ventures, and Rona, a partner at TLB Partners. I'm Barb from TLB Partners investment team. And let's start with an introduction, so feel free to tell us a bit about yourself.
So I'm Robbie. It's nice to meet everybody who I haven't met yet. I'm a partner at Cowboy Ventures. We're based in Silicon Valley, and we're focused really on seed and pre-seed stage. And we have a pretty limited portfolio, so for every fund we invest in 20 to 25 companies. So in some ways I think very similar to a lot of Israeli seed funds. And before Cowboy, I was at a fund called Norwest, which also has a pretty big presence in Israel. So that was my first experience with the ecosystem here. And I made my first investment in Israel about a year ago, maybe a year and a half ago, and really excited to spend more time investing in the amazing founders here.
My name is Rona Segev, and I'm one of the partners here in TLB Partners. We started 8 years ago. I raised our first fund, which was $110 million. Since then, we raised 7 funds, more than $1 billion. We just announced our 5th early stage fund. We mostly do seed deals, rather big seed deals. We don't invest in a lot of companies, but when we do invest, we put a lot of money. And hopefully, our entrepreneurs will tell you that we also care a lot. Actually, it was really nice when I started working with Cowboy Ventures, and with Robbie, we really found a partner that feels very similar to us on how to work, about the culture. It's been working very well, and this is why we were so thrilled to invite her here and kind of introduce her and you guys to her as well.
Thank you. So just for the context in general, how would you describe the macroeconomic trend in the past year?
I'm happy to start. So I would say it's been very confusing because the way the year started, it was very slow from an overall investment standpoint, particularly for later stage rounds. And then you had this kind of separate trend going on with generative AI where valuations seem to be kind of 2020, 2021 level. And so you had this one segment of the market that was raising crazy valuations, crazy rounds, and had a ton of demand, and then the rest of the market was really struggling. And now I would say things have settled a good amount. So we've actually seen on our side, but also from other funds, a lot more interest in investing. And I think the macroeconomic situation around where multiples are landing on the public market side and where budgets are holding, it's normalized a bit. So we are seeing a lot more interest and things, I would say even over the past month, we've seen a lot more really awesome deal flow, and we've seen a lot of Series A and Series B investors really taking a close look at our portfolio, much more than the beginning of the year.
For me, this is a rather confused situation. On the one hand, on the market side, on the buyer side, there is kind of some weakness, but they're asking for more discounts, sometimes kind of delaying their decisions. But overall, companies are selling. If we look at our portfolio, they're growing at a rate of 20% quarter over quarter in revenue run rate. This is very similar to the pace that we had in 21. It's not that different. So on the market side, there was a lot of worrying, a lot of people worried about something dramatic happened, but actually companies are still selling if they have a valid product. What happened on the VC side, on the other hand, is just a catastrophe, really. So VCs just stopped investing. And although you see that Gen AI, there were a lot of investments in Gen AI, still in Q2, it was one of the lowest quarters of investments in the world, which means that every dollar that went into investment went only to Gen AI. So the rest of the companies really, really suffered. We are seeing some change now. I think Gen AI kind of reminded VCs that what their job is and they can actually make some investments. The problem is that, and we just talked about it a few minutes ago, is that VCs are having a really, really hard time fundraising. And 23 is going to be probably a terrible, terrible year for fundraising. So all of those VCs are still kind of running on money that they raised 2 or 3 years ago. And even though people are talking about the dry powder, I don't think it's real. I think most of this money is actually allocated to struggling companies. So they don't have a lot of money to invest, and they're having issues raising new funds. So I think it's going to take a while. I think until we're going to see real improvements in VC investments, it's going to be late 24, 25, but we need to give the market some time kind of to get back to where it is. But this is a weird situation. You know, I went through the crisis in 2000 and 2008, and it was very, very different. The buyers stopped buying, and the VCs didn't have money. I've never seen a situation where the buyers are still buying, but the VCs just ran out of money. So this is the current situation in my mind.
And can you elaborate on the seed and A deals that you see right now, both in terms of number of deals and valuations that you see?
So I'll start on the seed front. For seed deals, I would say it also is a little bit tale of two cities, where generative AI seed deals are super competitive and are getting done in the 20s, maybe up to 30 million valuations. And I would say some sectors like security and infrastructure also have held pretty high. But for the rest of, I just do B2B investing, so for the rest of the like B2B sectors, we've seen a number of those come down. And the reason is, so we ultimately are always trying to make investments where we think it'll set the company up successfully for the next round. And so as public multiples have come down, those are slowly tracing back to earlier and earlier stage rounds. So for seed rounds, we are seeing those now sell quite a bit, with the exception of sectors that are just really hot right now and are just getting a ton of investment. And I would say even for us, we are seeing a lot of AI deal flow. We have an LP meeting coming up, so we're going through the numbers, and we've looked at over 500 AI investments at seed this year. And there's just a ton of potential in the technology, but it's also just where we're seeing the most deal flow right now.
Yeah, in terms of, well, you can tell more about the numbers and probably see it. In terms of that, we're seeing a lot of deal flow actually from the beginning of the year. A lot of C deals, not so many A rounds. I think the good companies in the A round are waiting. Okay, they will not go out right now. Okay, this is a horrible market. No one wants to raise money, so they're waiting. But we're seeing a lot of C deals. There was really an inflection in terms of the amount when Gen AI kind of started to be more popular here in Israel. And by the way, it took us 3 months after it happened in the US. We were very busy here with the political situation. I think we kind of missed the first wave, but very quickly the Israeli founders kind of catched up with what is happening all over the world. We're seeing a lot of deal flow. We're not necessarily seeing a lot of different things. Many of the entrepreneurs are coming with the same concept over and over again. Yeah, but we're saying we've done 5 deals, C deals this year, which is kind of quite a lot. It's kind of our regular pace, so we haven't declined in pace. In terms of competition, there is some competition on the C deals. It's really declined. So a lot of the VCs are not really doing deals. In terms of valuations, not really. Okay, so a lot of founders used to come to us asking for $5 to $6 million, $7 million. Right now, many of them are coming asking for 4 or 5. But I must admit that the good companies, we usually really ignore what the founders are asking for or not. And we basically tell them, listen, salaries didn't go down. You still need 2 years. You actually do need $5 to $6 million, okay? And that in turn kind of determines the valuation of the company because you need to have like a normal cap table, a fair cap table for everyone. So we haven't seen a real change. If you look kind of at our average valuation, average round, it actually stayed the same in the last 2 years. That's the truth.
Thank you. So moving to investment criteria, Robbie, let's speak about the elephant in the room, 1 million ARR, which we hear everywhere when we talk with US VCs about A rounds. So what do you think about this metric? Is it true? What are the exceptions for it? And so on.
I think it's an easy metric to point to, but I think what matters more than getting to $1 million ARR, that the best Series A investors are looking for is repeatability in the model. So if you have like 2 customers that you're making a ton of exceptions for and you're doing services revenue and that gets you to $1 million ARR, that's not nearly as valuable as a machine that is already working and you have a number of different customers that are being deployed the same way. And really the best Series A investors are looking for an engine on the go-to-market front that's working. So they want to know that, okay, I'm going to invest, you're going to scale out your go-to-market team, and we're going to see more of what you're already proving out now. So I think $1 million ARR is an easy metric to point to, but depending on the company, it could be less, it could be more. I think knowing whether or not you have product market fit and the model is repeatable, that's what investors are looking for.
And are there any other criteria and metrics that you are looking for in a round?
Yeah, for sure. So on the efficiency side of things, we want to see how much sales and marketing was spent in order to get those customers. And we also look at things like product adoption internally, if there's anything around retention or just like growth within customers. We're like overall looking at just health of the business. And by Series A, there's usually enough metrics you can look at to say, okay, is this a high gross margin business? How long does it take to get customers set up? How long does it take for it to scale internally? But usually the high level metric is something around ARR, and then you look at all the components that fit behind it.
Okay. Rana, are there any things that you are looking for in seed rounds? I know it's a bit more difficult because we have no data in seed round, but what are the criteria and metrics that you are looking for when you invest?
So, if I may, just on the A round, you should be very, very careful with those buzzwords of $1 million ARR, because we as VCs, when we want to decline a company because we don't like the entrepreneurs, for example, we will never tell you we don't like you guys. We will always tell you, well, when we reach $1 million ARR, call us back, okay? Or the market is too small. So, frankly, and this is reality, so, and sometimes I hear like, my companies are coming back. They told us $1 million ARR, and we'll get there. We can call them back, and I'm kind of maybe not, guys. And I've seen many companies that raised A rounds with 0 ARR, and many companies that couldn't raise funds with $3 million of ARR. So I think what VCs are really looking is to really get excited and to believe that there is something big here. ARR sometimes help, okay? Sometimes not. But just be careful with using those buzzwords and really kind of treating them too seriously. And in terms of seed, I think the 2 things that are really important to me is one thing is to understand that the entrepreneurs really invested time in understanding and exploring their concept. Listen, when we are putting $5 million in a company, we create this quiet agreement with the entrepreneurs. We give them $5 million and they give us back 8 years of their lives, okay? Which is kind of actually a cheap price to pay for someone's life. And listen, and if I lose the $5 million, I lose it. This is my business, okay? My investors understand that. But if you lose 8 years of your lives for something which you haven't bothered to check whether it's worth it or not, this is something which is a huge, huge red flag for me, okay? So really, I'm looking to see people that dedicated the last 4, 5, 6 months, like really exploring, talking to customers, understanding what they're doing, that they're coming to me very mature. And the other part is that they have someone on their side that they actually trust. Like the worst thing for me is to invest in this, like the main reason that companies are failing is because of the entrepreneurs are fighting between themselves. Really. The second one is because they have shitty investors, really. They think they know everything. But the first one is because the entrepreneurs are fighting. And going out for this journey with someone that you met 2 weeks ago on founders meetups, right? How do you call that? Yeah. And I'm like, it's nice. For me, it's not enough. So, and then that you have a market that is worth it and going after, and that you have a concept which is not like the most trivial thing that you can think about, but kind of like you have some imagination kind of invested in the concept.
Yeah, just one point to follow up on what Ronan said. To think that there's just one magic number where if you hit $1 million ARR, suddenly investors are going to be interested, like that's one piece of a much bigger story. We're looking at the founders, we're looking at the market, if this team could become the market leader, like there's so many aspects to it And just hitting $1 million ARR is just a very small piece of it. So I think when investors say that, it's just a really easy out as opposed to, oh, come back as soon as you hit that. There's a lot that they're assessing outside of it.
So in this context, what common mistakes should founders be aware of when they present these metrics to you?
Well, I think the biggest one is assuming that that's the full story. That here I hit $1 million ARR, so I'm ready to fundraise. I think that some of the most common mistakes, and maybe this is a different way to answer the question around fundraising, is just presenting the data and saying, oh, here's everything that we've done, as opposed to thinking about the story and how you're actually, because from the investor side of things, especially with funds like the size that we've raised and that TLV's raised, you're really looking for companies that can become really big, and the market can sustain that, this team can go after that, they can like recruit the right people, they can sell. So like thinking about when I meet with a founder, and if they don't have kind of that story of here's everything we've done, here's how this is going to become a really big company, and what we've done so far is act one in that, like that's what we're looking for versus them just presenting data points.
Thank you. We see many startups that are between seed and A and are going for a safe. That doesn't have yet the tough metrics for A round. And the question is, what do you suggest for them to do? And if they consider safe, are there any mistakes they should be avoid, or any suggestions for them considering the safe round?
I think you're going out for the A round when you have a good story, okay? A good story includes sometimes metrics, okay? But it's a good story. And sometimes it takes a while to build that story, and then sure, take safe, take a bridge. Just make sure that kind of the terms are reasonable. Listen, when we look, like a few, and this is happening all the time, a week ago, and a really interesting company came to our room and kind of presented their idea. And then they told me about their previous investors, and I got kind of worried, and I asked about the cap table. And it turned out that the previous investors are holding right now 45%. The company, after the company raised $2 million. For me, this is a showstopper. I will not continue, okay, with the deal, no matter how good it is. So just make sure that when you're raising money, you are not ruining actually your chance to continue afterwards.
Yeah, and I would also say, like, we also look at quality of investors a lot. And so I think sometimes what I've seen with founders is if they haven't done cash planning properly and they're not ready for an A, and they just try to raise quickly and they're not doing references on who the investors are, like, we care a lot about the quality of investors, of who's part of the company. So I think for any capital being raised, being really thoughtful about who's being brought on board matters a lot.
So let's move to investor and founder dynamics. Did anything change during the last year?
She's the nicest person ever. So no.
Well, I would say...
Generally in the market, not only for you, from what you see.
Well, I mean, this is the first time, even for me, so I've been investing for 8 years, so this is the first kind of, and it's kind of a down market, but it's a bit of a confusing market, but it's just very different. And the fundraising environment is definitely different, and the expectations to get to Series A and Series B are different. So it's changed in the sense that there are a lot of companies doing layoffs. There are a lot of companies that raised it too high of a valuation, and now they have to look at doing a down round, or at least a flat round. And so it's a lot of tougher conversations, because I think like during 2020, 2021, it was kind of all up and to the right. And so now things are tougher. So it definitely has changed relationships. But I also think it's a good moment where VCs can actually be really helpful in thinking through how to manage communication with the company, how to manage tough conversations, how to fundraise if your metrics don't look amazing, but how to think about what expectations to set, and how to kind of talk about how the last year maybe your revenue growth wasn't as high as it was going to be. So I think this is actually a moment where VCs can be really helpful, but there's definitely, it's more challenging than it has been for any other years that I've invested, for sure.
Yeah, there is a new phenomenon which is interesting actually. There's a lot of very young VCs that joined the industry like 4 or 5 years ago. And they had an amazing early run, okay? And now suddenly everything is falling apart. And many times the managing partners are threatening them or kind of making it very clear to them that if their company will not do very well, they'll be out of the fund. So they're actually fighting for their survival. And I've seen it in some of my companies. Those guys are becoming very, very aggressive and sometimes very unpleasant, the boards. They're under a lot of pressure. And in a way, they're even sometimes blaming the CEOs for kind of their career or their kind of potential failure. So we see things that we haven't seen kind of like 3 years ago. And sometimes it's really actually very hard to protect the CEOs from that. So this is one thing that we've seen that is changing. Another thing, I just looked at the pitch book. It's interesting to see kind of the terms. And they kind of measure the term sheets by how entrepreneurs friendly they are and how VC friendly they are, which means do you have credential preference and stuff like that. And the change is dramatic in the last year. It became from very, very entrepreneur friendly to very, very investor friendly. And I find it quite funny because haven't you learned that kind of like the world is kind of circular, it's kind of like it's coming and going, and and why are you optimizing for the short term? But I think we are seeing more and more kind of term sheets and kind of terms that are very, very investor friendly and very not entrepreneurs friendly. Again, those things are changing very quickly, but we are seeing that.
So maybe you will dive deep into the terms of a deal, because we also see a lot of changes in term sheets lately. Can you elaborate on what changes do you see in liquidation preferences or veto rights, and what founders should be aware of?
So everyone who knows me knows that I'm fanatic about veto rights. I hate veto rights. Really. I think it's kind of like giving nuclear weapons to everyone around the table. So just take it off. So no one will have a nuclear weapon, and we're going to be so much better, okay? Just force us to collaborate instead of giving us weapons. And when we started TLP Partners, we had the freedom to do it, because before that in other funds, really insisted that I'll keep the veto rights. And in the first few years, it wasn't a problem to convince investors that came after us to maintain the status quo that no one has veto rights. In the last year, and especially in the last deal that I had like a follow-on deal, this was like a huge fight with the new investor. Eventually, I'm so happy they gave up, and kind of I convinced them that it's good for everyone. But it was new for me that I really had to fight with the investor, because they knew that they can actually ask for it and get it. So this is something that we're seeing new. Also, liquidation preference. Listen, this liquidation preference is a bad thing for everyone. It's bad for the entrepreneurs. It's also bad for the investors. It creates conflict of interest between the different classes. Mm-hmm. So when you get to an exit, suddenly I can have one interest, Robbie another one. This is not good, okay? But right now, this is again becoming common to ask for liquidation preference. And again, this is something that we're trying to fight. Just to keep the company healthy, really.
Yeah, the other term we've seen in two of our late stage companies, which I actually think can really help the cap table, is it's called kind of like a pay to play. So if there's a new round at a lower valuation, instead of there being a huge stack of liquidation preferences, trying to trim those down and making it so any investor that participates in the new round, they will keep their preference versus converting. So that we've seen, but I actually think that's been more helpful than not in some companies that really needed that restructuring, and they didn't want this huge liquidation preference kind of sitting on their cap table.
Thank you. Okay, moving to the political situation in Israel. I will just say it's not a political discussion. We want to talk about it to understand the risks and mitigations that we see in the situation. So, Robbie, as an American investor, how does the legal revolution impact the way you view the Israeli ecosystem?
So for me, and I don't want to talk too much about this just because this isn't something, I would say from the US, there's a lot of, it just seems like a lot that's up in the air and that's being figured out politically, but it definitely does cause some concern. Like we've gotten a number of questions from our LPs about how much more time we want to spend here, if there are going to be entrepreneurs leaving, or if things change and we just don't know how to predict them. From my perspective, I love the founders here. I love working with our partners here. So I'm hopeful that we're going to be able to still spend just as much time. but it definitely hasn't been good for the ecosystem.
Not a surprise. Rona, what risks associated with the legal revolutions, and what measures do you advise your startups to act with?
First of all, no risks at all. Okay. No. What we're seeing is a sad phenomena that all of our startups, all of them, all the new companies, were incorporated in the US. And I think the most worrying thing about it is it wasn't even brought to discussion. It wasn't even an issue. It was so clear to them that this is what they should do because the lawyers all advised them to do it. And this is sad because it means that eventually they'll headquarter in the US, they'll do a relocation. You know, we worked very hard to kind of convince the world and the Israeli entrepreneurs and the VCs that you can have the headquarters and the management team here. This is changing very, very quickly. So the companies are moving back to the US. This is actually very, very sad for Israel. We see a lot of relocations in our companies, and it's growing. So, and we see, and it's not just the entrepreneurs, it's actually mostly the employees, a lot of the R&D. And sometimes this is a request or a demand for even joining the company, that they have the relocation option. Sometimes kind of if let me kind of work from somewhere else in the world if you don't want me to leave. So this is an issue, and I had some companies, not necessarily from our portfolio, actually approaching me, asking me to help them kind of establish a company, a sub-company in Greece or in Portugal for R&D people that want to leave because they do want to keep them as a group. So this is again something very, very sad that is happening right now, and I think we're going to see it growing. I think every time there is something major happening here, there are a few more families that are convinced that this is maybe a good time to live for a while. I don't think they're calling it to live forever, but at least for a while. We do hear that a lot of VCs are kind of waiting. I don't think they decided not to invest in Israel anymore. But they kind of prefer to wait. Why rush? Let's wait, let's see what's going on. And this is also for strategic buyers, acquirers. This is something that we heard, that again, they prefer to wait a little bit with Israel. The good thing is that the Israeli high-tech ecosystem was never really connected to Israel, the land, okay? If you look back 15 years ago, it was actually based in the valley. Even the VCs, we had branches, all of us had branches in the valley because all the Israeli entrepreneurs immediately moved to the valley and they would bring all their friends, and many times they had like R&D centers in the valley. It's actually a phenomenon of the last 10 years to bring back the high-tech to Israel, and it was for Zionist reasons, okay, in order to bring kind of tax back here. And I do believe that the power of the Israeli high-tech is the community, and the community can be great. It could be anywhere. It's still going to be a community. But it's sad. Listen, it's sad. You know, probably you've been following, you know, that we've been very vocal about it. We're not ashamed. We're not afraid to say what we think. And it saddens me deeply, really, what is happening here. And I hope we can solve it. And if not, we'll open a branch next to you guys and work with the Israeli entrepreneurs that we live in Canada, Barcelona, whatever. Let's hope that we can fight it and like the things will relax and will calm down.
Okay, moving to generative AI. Have you heard about it? No. Okay, so how do you evaluate Gen AI startups today? What are the most important criteria you should have?
So I'd say we're seeing a lot of companies really effectively use generative AI, and it doesn't necessarily mean they're generative AI companies versus they're just going after a certain vertical or customer pain point. Where that's different, I'd say, is in the infrastructure layer. There are more new types of infrastructure, it seems, that these kinds of applications need, whether it's vector databases, different data labeling capabilities. But on the application side, we actually just made an investment in a generative AI customer support company, but ultimately they're servicing companies on the customer support side, and they're just using Gen AI to power that. So as far as what we look for, we're ultimately looking for kind of the same things from a founder perspective. We're looking for founders that are addressing customer pain points. They're using the best possible technology to do that, and in a lot of cases that means generative AI capabilities. And I would say it's interesting because so many investors will say now, like, oh, I'm an AI or I'm a Gen AI investor. And I think it's just touching so many different areas of tech that I think everybody's aware of it. So like the best founders are really thinking about how can they implement it internally for just efficiencies and also for customer-facing products. But it's just kind of touching everything. But we're still evaluating founders the same way.
Yeah, for me, Gen AI is just like saying, I don't know, it's not like, but it's kind of like saying cloud. It's just an infrastructure, a new technology, an amazing technology that you can use if it makes sense in your product. And you should if it makes sense, because it really kind of opens new things. And you can do, but at the end of the day, it's about the product. And Gen AI is another amazing technology that you can use, and many entrepreneurs decide to use it. And a lot of entrepreneurs in our portfolio that already have established companies are using Gen AI as well, and kind of generative foundation models, and doesn't kind of, so I think kind of like there is a lot of buzz, but I think at the end of the day, it's a real thing, it's a revolution that is happening, it's another technology that companies are going to use to develop amazing products, and that's it.
And what are the latest investment trends that you see except of Gen AI or things that interest you?
Gen AI.
I mean, I would say it's hard to look at what's going on right now in Gen AI and not be excited by it. It's probably the newest, biggest wave that we've seen. But, I mean, we're still seeing, I look at a lot of infrastructure and security. I think within security, I mean, I'm sure there's some security founders here. They're amazing companies that come out of Israel. We're seeing just really high quality products. We're seeing a lot of even, not just generative AI, but AI kind of permeate in different ways. But yeah, for us, I'd say on the budget front, we're seeing a lot of companies look at cost-cutting measures and look at just how to be more efficient. And so just a lot of tools that are going after the kind of more budget-constrained world of today and are super high ROI. But yeah, I wouldn't say, from a technology standpoint, generative AI is the biggest kind of new thing that we've been following.
Yeah, I think that it's very similar to what happened with the cloud. When the cloud kind of started, there was suddenly an opportunity actually to replace a lot of old solution, kind of on-prem solutions with something new. And we saw a revolution, we saw a lot of companies coming, and actually a lot of things changed. I think with Gen AI, there is a chance now to replace another kind of layer of different applications, and we're starting to see those companies coming, okay? Using this new technology kind of to come and change the way the applications are working and the way we think even about kind of different things. And this is, I think, the most exciting things for me to see. And we're not seeing enough, but hopefully we'll see more and more of those.
Okay. Is there anything else you want to say before Q&A?
I mean, only other thing I'll say is I'm just really grateful to meet all of you, and just a huge thank you to the TLV team. It's funny, this is my first investment in Israel was with the TLV team, and I think probably most of my investments here will be at the TLV team. So just thank you for this, and it's so great to meet a lot of you. A lot of which I've met virtually, but haven't been able to meet in person until today.
I think we should thank Mayan from Elementary for introducing us. Okay, so questions. Feel free to ask anything. Yes.
Hi, Adam. I have two questions. First of all, you said, Rona, that seed rounds should play for about 2 years. For pre-seed, what kind of timeline founders should aim for? And the second one, what's the sentiment about founders coming to pre-seed or seed rounds without any previous angel investments, solely bootstrap or something like that?
Actually, I will advise you not to do a pre-seed round. The problem is, really, when you raise even 500K and you're already running for 6 months, suddenly, and it's crazy and it's not rational, but this is the truth, I want to see a company that can fit the A round kind of criteria. And this is like this is sad, but this is true, okay? It's very hard for me kind of to say, well, he raised only 500K, okay? I don't know why, but, and actually companies that are raising small sums and been running for a while are usually having a much harder time raising kind of a bigger seed round. So I would really concentrate on raising a big seed round and not kind of splitting it. And it's fun, you can come. Usually founders are coming to me with kind of angels that already committed, but didn't invest yet, or just put it safe like a few weeks ago. But, it's like, sorry, I'm talking too much maybe, but, it's like, sometimes I tell my founders when they go out to A round, let's go before we start selling. Sorry about the $1 million ARR, because sometimes telling the story is better than showing actually the reality. So, and it's the same with the pre-seed. Just kind of sell us the dream, the team, and raise enough money to actually have enough time and money to prove yourself.
Yeah, I would also say that we are almost always the first money in, and so we're kind of the pre-seed. And also, some founders will raise $4 million, they'll call it a pre-seed. So it really, I think generally a lot of seed funds are the first money in.
Other questions? Yes.
So, empowering Adams in the audience, I'll just ask, what's your outlook for Q4? Is there any change in the strategy or the macroeconomics affecting your decision-making in fundraising?
I would say, so the last month we've seen really high quality founders and ideas at the seed stage, and so I imagine that that's just going to continue. For Series A and beyond, I think for us and probably Rona and a lot of seed investors, we've been coaching our founders to kind of make it through this year. So we don't have any companies going out to raise Series A. I think we want to see that market improve before founders go out. So I would say at the seed stage, we're probably going to continue to see more. But for any of our later stage companies, probably not until next year going out to market.
Anyone else? Don't be shy.
What do you think changed in the kind of playbook or advice or like the way entrepreneurs should operate in the early stages, after seed round, before seed round? Because I feel like today we're operating the same, but it became more consensus. And then a year and a half ago, I felt a lot of pressure maybe to operate differently. So like, how did you see that change over the last 2 years?
Well, VCs were really pushing entrepreneurs to spend a lot of money and run, and entrepreneurs were pushing and kind of like they could have the secondary and kind of raise the valuation. I think everyone's kind of more cautious right now in terms of running. But frankly, I don't know, I never pushed my entrepreneurs just to waste money. And I actually think that what you should do, especially at the stage that you are, is just build a really healthy company, just find the product market fit, kind of understand the motion of the go-to-market motion. And you should do it quietly, and kind of, like having 50 people will not help you, actually will confuse you. So, it really depends who, but I think probably it didn't change a lot. We just look more in the runway, just making sure that we have enough money. And we encourage entrepreneurs to take seed or whatever, just to make sure that we have enough time.
Yeah, this is more for later stage companies, but for the past 2 years, we've heard all growth investors talk about burn multiple a lot more, which is very simply how much money you're burning to versus how much net new ARR you're generating. And it used to just be kind of growth, and people kind of looked at efficiency, but now it's like from a growth perspective, much more about dollars in versus dollars coming back out.
Yeah, but this is for later stage companies.
So you think at the seed nothing changed in that aspect?
Listen, like in 21, we had entrepreneurs that, frankly, I do think that the only reason that they started a company is to have an up round, do a secondary, and go home. And this phenomena changed, okay? And there were VCs that were kind of participating in the party as well. And I don't think they're doing that anymore, hopefully. But no, I think that kind of like the really serious entrepreneurs, also like 2 or 3 years ago, understood that at the seed stage, they need to build a healthy company. They need to understand that they have the foundations to continue. And kind of like, they did it quietly. This is my experience, at least.
Can you talk more about industries maybe that now underestimated, that going to go through some major changes with all this AI revolution, and maybe like VC now is looking into them now more and more, that now they were underestimated before?
So I think there's been a lot of buzz around the generative AI infrastructure stack and the foundation models, but I think there are going to be a lot of verticals that have smaller models that kind of reinvent categories and are much more efficient. So that's an area that my partner Aileen is spending a ton of time in. Because historically, a lot of verticals VCs looked at and thought they were too small for venture-sized outcomes, but I think if you build a really effective product using a lot of generative AI capabilities, then you can grow to be quite a large market share of certain verticals. So I think that there's been so much buzz around these huge foundation models, and everybody's kind of dumped money into whichever one that they've picked as kind of their horse. But I think the smaller models and more like function specific and vertical specific ones are where there's going to be really good business value created.
And another space which I'm not sure about is the climate, because listen, things are changing, we cannot ignore it. And my assumption was even 2 or 3 years ago that we will have to face what is happening, we'll have to come with a solution, we'll have to start buying and investing money. Problem is that with time I'm starting to be less convinced that we will actually, I'm starting to think that maybe as things will get worse, we'll actually turn to God to pray instead of dealing with the problem. This is kind of the phenomenon that I'm seeing right now, which is kind of scary. And just try to ignore what is happening around us. But theoretically, rationally speaking, this is a good area to invest in. We haven't seen almost any companies here in Israel. The Israeli entrepreneurs are really shying away. Not sure why. Maybe, I don't know.
Maybe I would add that the areas that I find the most interesting and that will revolutionize by Gen AI is you need to look at the data, and places where the data is relatively structured and has context between words, it's easier for Gen AI to do a major application there. So, for example, legal tech or accounting, I think we're going to see a lot of interesting companies go out from this
What
area.
about education, for example?
Tough question, I don't know.
Is education a hot market in the US? There's a lot of investments. Because we haven't seen anything in Israel.
It wasn't, and then it was for a period of time, and I would say now it's kind of settled. I do think that there's a lot of opportunity with generative AI to create kind of personalized teaching assistants, personalized education journeys, but there haven't really been the exits from a venture perspective for it to be a super hot category. Maybe that'll change, but I would say that it's been tougher for sure. And then in the enterprise, L&D, learning and development budgets have been cut pretty significantly during the last few years, so that's also made it pretty challenging.
Any other questions? Any question you came here and we didn't answer? Okay.
Questions are good.
Thank you very much.